Okay, welcome everybody to today's webinar, SMSF contribution strategies. Great opportunities await those that get them right. So, look, what I want to work through today, it's going to be a fairly fast-paced session as I want to run through a little bit to do with the rules around contributions, and given that there's been some significant changes over the last few years, so many of you would be aware of them, but I want to tie some of those together. Then I want to touch on, probably I've got three strategies that interlock with a number of other strategies. So I'll probably work through about 6 different strategic concepts in the webinar, and then talk a little bit about the issues associated with what might occur when things go wrong. So as I said, it's going to be a pretty fast pace for the session today. So if you've got any questions, by all means put them in the Q&A box, and I'll attempt to get to them as we go through. And if not, hopefully I can get to those questions at the end of the session. So what I'm going to talk about today, of course, the disclaimer being a very important piece, given the fact that we're in an ever-evolving superannuation industry. We saw legislative changes, or we've seen legislation introduced over just the last couple of weeks that impact such things as First Home Super Saver Scheme, obviously NALI, and the big one being the objective of super. So we are in an ever-changing environment, and we need to make sure that we keep up to date with everything as it goes along. So we're going to talk about the impact of and opportunities are linked to those revised contribution rules. And then I'm going to touch on a lot of the notice and election requirements as well, because when we're talking about contribution strategies, we need to make sure that to meet our eligibility requirements, that the trustees and members do what's necessary of themselves to provide the necessary reporting to the super fund or to the tax office, or whoever it might actually be that they need to report to. So we'll work through that. And then, as I said, finish off with the issues associated with excess contributions when people tend to get things wrong. And sort of my take on the super reform of the past few years is that I actually believe now that there's greater capacity to get things wrong, albeit that we know that when people do get things like non-concessional and even concessional contributions wrong in today's environment, the impact is not as significant as it once was, say, pre-2012. So in that sort of nasty period from probably 2007, 2012, 13, we're in a pretty awkward tax position with a lot of the excess contribution rules. But now they're certainly a lot softer, but we still want to avoid them, just so we can avoid the problems associated with them with regard to how long things take to work through the contribution problems as such. So look, where I wanted to start with is and I probably shouldn't really classify this as the problems with contributions, but it's really the considerations of making contributions that we've got 2 elements that we need to contemplate, and that is firstly that we've got the acceptance rules. Now the acceptance rules are pretty straightforward these days, and I'll run through those in a moment, but they're all housed in the SIS Act. So from an acceptance point of view, the ability to make contributions and for trustees to receive it is a fairly straightforward process, and that's all contained within the SIS regulations, Regulation 704 to be precise. Then once we break down, or once we have contributions accepted into a fund, then it's the issues around eligibility for various tax concessions, determination of whether they are concessional, non-concessional, whether they are exceptions to the non-concessional rules. So if we're looking at downsizers, CGT, small business contributions, personal injury amounts, all these elements, and then what is assessable, what's not assessable, and of course the caps associated with that. All of that is housed within the Income Tax Assessment Act, and so we have to cross swords a lot in the contribution space to make sure that we are getting things right with regards to our limits and other things. Because then obviously things, as I said before, like the excess contribution rules, which are housed within the Tax Act, also can kick into place. So I feel that there is a greater capacity for individuals to get things wrong. And it's obvious that there's now less capacity for trustees and for individuals to rectify than there once were. And a lot of this is based on the fact that over the last 6 years alone, there's been over 25 law changes. Now, some of those law changes are as simple as indexation, but of course, we've just passed over 1 July 2023, and with the indexation of the general transfer balance cap, that's a classic change that again impacts what we're doing from a contribution point of view. And inevitably, there's going to be a lot of people who potentially didn't qualify for the bring forward provisions potentially last year, who would now qualify because of that upward movement in the general transfer balance cap from 1.7 million to 1.9 million. So just changes like that on top of all of the additional changes means that we've seen a significant amount occur in the contribution space over, as I said, the last 6 years. And I probably lost count if we go back sort of 15 years into this space. So with the contribution acceptance rules, what we know is that we had a very significant change that took place from the 1st of July last year, 2022, where we had the uplift in the ability to make non-concessional contributions right up to, or to make personal contributions, should I say, up until age 75 without having to satisfy the work test. And of course, the ramification of all of that was that this table here, which is taken directly from the SIS regulation 704 that I referenced before, previously the work test used to be housed within this regulation. And so it used to talk about, subject to being over the age of 67. If we satisfy the work test, then we can make contributions between 67 and 75. So now that's been removed, and we've just got these three basic tables, or these three basic rows within the regulations, and that is for those under 55, where they can receive employer contributions and make member contributions. Between 55 and 74, or at least 28 days following the end of the month in which you turn 75, you've got your employer contributions, your member contributions, and the inclusion in those member contributions of downsizer. And then once the member is 75, we've only got mandated employer contributions. So we've only really got award or super guarantee, or we've got downsizer contributions. So the simplification of the SIS regulations meant that more people were eligible from an acceptance point of view to make contributions into superannuation. Of course, what that means is that once those contributions are accepted, then they're subject to all the various other rules. And as I said, that's where there's potential for issues. But the other key thing is that with that change, it meant that all contributions, and ultimately this has always been the case anyhow, but I think this has put a greater spotlight on it. All contributions as they're received that are member contributions, so forgetting employer contributions for a moment, all contributions that are received that are member contributions are ultimately non-concessional contributions until such time as an individual lodges or makes their election to claim a personal tax deduction. So they lodge their 291, the notice of intention to claim a tax deduction. And this is where the significant change that came in from 1 July 2022 took effect. And that is that to be able to claim your tax deduction, then you, from age 67, so basically from the day of your 67th birthday, right through to 75 or 28 days following the end of the month in which you turn 75, to be able to claim a personal tax deduction for contributions made in that period, then individuals must meet the work test. So we've seen that work test move from the SIS Act from an acceptance point of view to the Tax Act to be a deductibility point of view. So if we take last year as an example, if somebody that was age 67 or somebody who was just prior to age 67, they could make a contribution from the 1st of July right up till their 67th birthday without meeting a work test, and then could claim their tax deduction by lodging their notice of intention following the end of the year. But then from that date of their birthday right up until, as I said before, their 75th or 28 days following the end of the month, then they would need to meet the work test. Now, the work test, unlike the SIS provisions, is something that just needs to be met during the year. So even if they'd met the work test prior to their 67th birthday during that financial year, and then potentially didn't work again for the rest of that year, they would still be able to claim the tax deduction, because the work test is an annual test that's required under the Income Tax Act. So again, if they don't meet the work test, then, as I said before, the contribution will be accepted as a non-concessional contribution, and it needs to be met at some point in time prior to the 30th of June. So again, the counter argument to my point before about meeting the work test before the 67th birthday is the difference is, unlike the old SIS rules, is you could make the contribution and then you could go and do work later, and then still claim that tax deduction. So you've got that little bit more flexibility built in with those personal deductible contributions. Of course, the flip side of that is that if you are making a personal contribution and there's an expectation that you want it to be concessional, then you don't meet the work test, then the tax deduction is going to be denied, then it's going to be treated as a non-concessional amount. And because we've now got the SIS 704 reg changes, your eligibility from a personal deductible contribution point of view is not relevant to whether or not the trustees can accept the contribution or not. So the fact that the trustees have accepted it and treated the amount as a non-concessional, then an inability to claim a personal tax deduction, or having that tax deduction denied for some reason of validity via the ATO, and we've seen a few cases recently where that validity has been raised because of the timing of notices, amongst other things. But if the notice is rejected or it's deemed to not be valid, then you're potentially going to create an excess non-concessional contribution, right? So that's certainly one thing that needs to be mindful of. If somebody is making non-concessional and making contributions under the assumption of claiming personal deductible, then they may trigger the bring forward provisions, and they may do it earlier than they expected to. So that's one thing to be mindful of. The other thing is, if they've commenced pensions and the notice is rejected, well, once you've commenced the pension, because you have to provide your notice prior to that point in time, by commencing the pension, you're effectively locking in the tax-free and taxable position of that pension commencing. You then have the personal deductible contribution rejected. You're not going to be altering the tax-free and taxable component of that income stream. So they're just sort of issues to certainly be mindful of as you go through that process. So it's pretty important from a timing point of view to get the contribution strategies right, and to ultimately, in my opinion, understand and appreciate that whether or not you are going to be eligible to claim that tax deduction. So the major eligibility issue is going to be whether or not you've got the assessable income to be able to offset it. And obviously for those between 67 and 75, that you've met the work test at some point in time during the financial year. So as long as you've got the income, no real issue. For those that are older and looking at it from a strategic point of view, as long as you've met the work test, then no issue. Then the amounts can be treated as concessional contributions. Then once they're treated as concessional contributions, you start to work down the various paths of where it sits, with potential ramifications from an excess contribution point of view. But as I said, we're going to get on and talk about those excess contribution rules a little bit later in the presentation. But what I wanted to work through for the sort of the majority of the remaining time that we've got is the issue around the contribution strategies that are available to us. And as I said, I want to work through a few of those strategies with all attendees today, and just sort of work through what opportunities are available. And I've identified effectively sort of a pre-retirement style strategy, so an accumulation-based strategy, but also then some transition and post-retirement strategies for us to contemplate. So when we look at contribution strategies, and this is not an unfamiliar slide for many of you that have attended potentially various contribution strategy presentations that I've done before, but I like to identify what all of the sort of the key contribution strategies that we see within the super environment that are available to us under most sets of normal circumstances for self-managed superannuation funds. Now, your non-SMSF funds are going to look very much so at all of the contribution strategies that are sitting there on the left-hand side, the non-concessionals, concessional, and the spouse contributions. And self-managed superannuation funds are often going to capture a lot of the other non-standard contribution strategies. Yep, appreciating that things like downsizer contributions are often obviously attributable to other funds as well, but the use of reserve allocations, often small business CGT contributions are going to be linked to individuals that are operating their own fund. The use of contribution reserving, fairly unlikely to have that apply outside of the SMSF style environment, but it's not to suggest that it's not possible in those other funds as well. So, we see a lot of these, and foreign transfers, probably one of the key changes over the last 15 years has been the concept, particularly with the UK, where a lot of the retail funds were effectively wiped off the board with regards to being able to accept foreign transfers, and it almost became, and I say almost because it's not exclusive to SMSFs, but it did sort of trigger into becoming the regime of self-managed superannuation funds to register as a qualified recognised overseas scheme to be able to have money come in from the UK in particular. And so we see a lot of those non-standard strategies linked to self-managed superannuation funds. What we also know is that most of these strategies are in some way, shape or form means tested. Now, what do I mean by that? Well, often under the Tax Act, particularly Income Tax Act, under other things such as super guarantee and SIS requirements and the like, you're going to have restrictions linked to all of these strategies. So recontribution strategies, bring forward strategies, your foreign transfers, anything to do with non-concessional contributions are going to be linked to your total superannuation balance. Again, things like your concessional contributions, so you carry forward, is going to be linked to total superannuation balance. Low income tax offsets linked to total superannuation balance. The spouse offset linked to total super balance. Then you've got things like super guarantee, which is for all of us stock standard, but we've now got a situation where, because of the indexation of super guarantee and because of indexation of the maximum contribution base, that we've got a situation for those that are earning obviously 200 or roughly, and when I say roughly, pretty close to $250,000 a year on a quarterly basis. That puts us at the maximum contribution base for SG purposes. So it means if you've got multiple employers, then that single employer is often going to take you right up to the concessional contribution cap, and then you're going to need to utilise that ability to elect out of super guarantee for the multiple employers if you want to avoid having excess contributions. So again, it's means tested in the fact that it's all based on maximum contribution limits, but also the contribution caps as well. And I can go on and talk through all of the other means testing elements, but a lot of the means testing requirements are linked to the fact that downsizer, you've got to meet the requirements of downsizer. Small business CGT, you've got to meet the CGT concessions. So first home super saver scheme, only certain contributions and timing wise. And as I said, there's been some changes there. So every contribution strategy is some way, shape or form means tested. And further to that, not only are they means tested, but many of the strategies, and particularly the non-standard strategies that we'll use or that we use in the SMSF space, a lot of them have various election requirements that are necessary. I would argue that all of them have at least the requirement for funds to be documenting that members have undertaken them and that trustees have accepted it. So, when you're talking about trustee minutes and things that I would be minuting, any benefit payment that clients might be making, and of course the contributions as well, and often just the annual minutes that are prepared as part of the financial statements will document the various contributions that have been received, so that the trustees in some way, shape or form are at least documenting everything, but with requirements of our other contribution strategies and their election requirements. Then what we can do is we can look through the list here, and we can see that from super guarantee, you do have that opportunity to opt out. Personal deductible, you've got to lodge your notice of intention. contribution splitting, and I'm going to work through an example of contribution splitting in a moment for you. We've got to make the application to the fund. Again, concessional tax treatment on foreign transfers. Contribution reserving, how we do the allocation will require not only minutes to be prepared by the fund, but also then a request from the member to ensure that the contribution is not double counted from a contribution cap point of view by making that request to the ATO in a timely manner. So the list obviously goes on there with regards to the elections, but it's important, and the reason that I put all of these elections in there is because we would often be talking about a lot of these strategies on a daily basis with our clients and the variety of clients that we all have. But are the clients aware of their notice requirements? Are they aware of who they have to lodge that with? Is it with the tax office? Is it just something that is provided to the fund? And then, have the records been maintained adequately? And is everything there for when we do the end of year fund audit? So a lot of things to contemplate in that space. So what I wanted to do now is to jump into, as I said, I wanted to talk through a couple of strategies, and realistically, whilst it sort of is split into three, those three then sort of expand out to incorporate ultimately 6 of the strategies, or roughly 6 of the strategies that I highlighted on the earlier slide. So I wanted to start with the concept of spouse contribution splitting, because it's not something that we talk about a lot in the SMSF space, but I think it's certainly in the SMSF space where we tend to focus a lot more on things like the carry forward concessional contributions, total superannuation balance, because a lot of these things are front of mind. Then the concept of spouse contribution splitting is certainly, as we look at rebalancing and transferring money from one spouse to another, it's certainly a strategic opportunity that avails itself to many SMSF trustees, and particularly given, arguably at least half of all SMSF members, and that's just me sort of plucking a percentage or a number out of the top of my head, but I think the ATO numbers would back it up, that at least half of all SMSF members would have less than $500,000 as their member balance, meaning that many SMSF accumulators would be eligible for using the carry forward concessional contributions. And if a lot of them are only having superannuation guarantee contributions, then they've got that available cap space available too. So when we're looking at contribution splitting, its natural sort of bed partner there also becomes things like the carry forward concessional. So what we touch on first is the rules around contribution splitting. It is useful to help manage a member's total superannuation balance. And again, the example that I work through will highlight that as one of the key issues. It does allow us to split up to 85% of any concessional contributions after the income year. Now, I highlight after the year, and I've got a note here to say, obviously, if you've got people that are looking to start pensions, and start pensions with their full balance, then you would need to provide that splitting application prior to the pension commencing, because you're not splitting it from the pension interest. So the requirements are that the member spouse must be under preservation age at the time of the split request. And if they're at preservation age but less than 65, then they can still do it, but they can't have satisfied a further condition of release. So they can't have satisfied that they have retired. So if the only condition of release is preservation and they haven't met any others, then they can also do a contribution split. So therefore, we're not splitting any money over the age of 65. And as I said, if we've got a pension, then we need to be careful there. There was a time and a place that we could also split non-concessional contributions, but then we actually saw the introduction of spouse contributions. So this goes back many years, and so now we're only dealing in the concessional contribution space from a splitting point of view. Now, this is the key to start the conversation that I was alluding to before, and that is that the maximum amount of the tax splittable contribution that the member can split is the lesser of 85% of the concessional contributions for the financial year, because obviously we've got to account for the tax that is payable on those contributions, and the concessional cap for the financial year. So that's why most of us sort of think down the line of $27,500. But of course, when we contemplate carry forward concessional, then the concessional cap for the year is a moving beast with regards to those who have a total superannuation balance of less than $500,000. So ultimately what it means is that we can actually split more money if we haven't utilised all of the concessional contribution caps in a previous year and we have a total superannuation balance of less than $500,000 at the previous year. So again, there's some real opportunities that are available with regards to the use of carry forward. And we know how that works, came in 2018, and we can carry forward up to 5 years worth of concessional contributions. And so we're really hitting that sweet spot now. So 18-19 was the first year that we could carry forward amounts, and we're in that 23-24, which is really that 5-year period. So we are really into that sweet spot. But I wanted to add in one more strategic opportunity into this conversation piece, and that is the element of the use of contribution reserves. Because contribution reserves have been around ultimately since the caps were introduced in 2007, and they're actually around before then conceptually, but they really sort of gained momentum post 2011, and they got more coverage from the tax office from about 2011 onwards. And you'll see there that there's a reference to tax determination 2013-22. There are other determinations that you can allude to with regard to this space, and the tax office then confirmed it in their reserving bulletin back from 2018 to highlight that a contribution reserve is not a reserve for the purposes of the SIS Act. It is ultimately a short-term holding account. And the regulations provide that all contributions must be allocated within 28 days following the end of the month in which the contribution is received, which of course for 11 out of 12 months of the year means nothing, because it means the allocation is done within the same year. But it means for June contributions, the allocation could be made up to the 28th of July. Now, the ramifications of that are that you've got money received in one year and then allocated in another financial year. And so the question that arose following 2007 was, which year does the contribution count for cap purposes? And the tax office position was that it counts in the year of allocation. So not in the year of receipt, but in the year of allocation. So it means that we can make contributions in June for deductibility point of view, and then we can elect, or we can request that the tax office allocate that contribution to the following year for contribution cap purposes. Now, what we need to be mindful of is that accounting wise, there is no difference to how we account for the contribution. So if the contributions are received in June, we would account for them in June, and we would have them reported in the member statement. They would form part of the fund's assessable income. That way they can be married up from a personal deductibility point of view with any notice of intention to claim a tax deduction. But then we use the form, and it's got there the ATO request to adjust the concessional contribution form. We utilise that form to request the ATO to reallocate for cap purposes to the new year. So, I wouldn't say it's a seamless process. It should be a seamless process, but it doesn't mean some don't slip through the cracks and result in excess concessional contribution notices or determinations being issued. But if you follow through the process, you can tend to be relatively seamless and not create any problems for the fund. Of course, the issue associated with it is once you've allocated amount from one year into the next year from a cap point of view, then you really do need to be aware of the contributions made in that next year to ensure that you haven't inadvertently created a further breach for the fund. So I want to look at this example of Helen, which encapsulates all three of spouse splitting, carry forward concessional, and contribution reserving into a singular example. And that singular example is driven by the fact that Helen has made a significant capital gain in the year. And so in this instance, we've got Helen, who's earning her 45,000, who's 45 and earning 100,000 a year, only gets her super guarantee from her employer. So that is the totality of the super contributions she receives. But in the 22-23 year, she also sold an investment property. And it was a property that she'd owned from prior to her current marriage. And she made a significant gain. So if we work through the table there, and I'm not going to go through each item, but what we see obviously is that we've got the cap, as we highlight at the top there, and then we've got the annual contributions made, so the concessional contributions that have been made each year, which are highlighted as the super guarantee amounts, and then that provides us with the unused concessional, which gets added on to the following year. And if our total super balance at the previous 30 June was below that 500,000, then it increases our cap. So a lot of this data is stored on MyGov for individuals to be able to view. So if we're looking at 22-23 year, we've got the concessional cap of $27,500. We've got the unused amount from the prior years of 64,000. We've then got, right, so that takes us up to that 91,500. You've then potentially got the 27,500 for the next year, but we need to factor in the fact that there's 10,500 super guarantee this year, and there's going to be $11,000 worth of super in the super guarantee in the next financial year. So in theory, the total amount that Helen can contribute is $119,000, but that's ultimately $119,000 over the 2022-23 and then the 23-24 financial year. So let's look at what this means that Helen can do from a contribution splitting point of view. So we know that she's made these contributions. Her total super balance at 30 June 2022 was 485. So that's a tick of the box for the use of the carry forward. She had that unused concessional amount of 64. So she had that net capital gain of $100,000. She could make, so in addition to the 10,500 employer contributions, Helen could make 97,500, assuming that obviously some of that, part of that, goes in June from a contribution reserving point of view, but she could make up to 97,500 of personal deductible contributions utilising the reserves. And as we see there with 108,000, we've then left room for the $11,000 of super guarantee contributions in the next year. So that maxes her out for the 2 years. But that sort of provided a fairly significant position for Helen. But then if we take a step further, and we've got her husband, Jack. Now, Jack's got $100,000 in super. He can apply and do a splitting contribution splitting application after the 30th of June. And what we can actually do, or Helen can do the application, she can actually do an application to split up to 91,500 of her splittable contributions because her total super balance was less than $500,000. And what we know is that there are rules around what the amount is that you can split. We know the concessional cap for the financial year was 91,500, right? So that's the number that we're working on there. And that's based on the 27.5 plus the unused amounts from the previous year. But when we then look at the extension of the rules of the splitting application requirements, we know that it's the lesser of the cap, which is 91,500, and 85% of the concessional contributions made. Now, 85% of the contributions of 108 equals 91,800. So therefore, that 91.5 is what Helen can split across from her account to Jack's account, and that 91.5 will transfer in the 23-24 year. Now, to do all of this, Helen has to, firstly, she has to lodge a notice of intention to claim a tax deduction. So she's doing that for the 97,500, which was the amount that we stipulated before. She has to put in a request to adjust her concessional contribution. So she's made $16,500 or thereabouts in the June year. And from a cap point of view, that's the amount we want allocated to the following year to keep her under the cap. And then she does the superannuation contribution splitting application for $91,500. So by utilising the three strategies there, not only has Helen saved basically a significant portion of tax on her income, but she has helped to grow Jack's balance inside the superannuation fund. And then by doing the contribution splitting, Helen is theoretically keeping her balance in and around that $500,000 mark, which means that there may be a future potential again to look at splitting balances if another event occurs in their life. So, you can see from that there's a fair bit from an opportunity point to come out of it. However, from those 3 points on that page, there are a number of notice requirements that must be met to ensure that the fund satisfies and the members satisfy all of their requirements. So what I also want to look at, and I've used this from the point of view of spouses as such, but we can look at it from an individual point of view as well. Now we know that superannuation is questionable in the sense that with the objective of superannuation being front and center again, that the whole purpose of why we have superannuation is going to come under the microscope, particularly with regards to issues such as utilising superannuation from a estate planning point of view. However, there's nothing to suggest that it's going to cut out or stop the ability for us to use recontributions or spouse contributions from a balance equality point of view and from a rebalancing of tax-free and taxable components. So when we look at some of these strategies, again, we're linking them with other strategies that are available to us. And the first one that I would look at is the use of a tris. So as we know, preservation is very close to 60 soon. So we're sitting at 59 at the moment from preservation point of view, but soon it'll be 60, where everybody will be in non-assessable, non-exempt income status, meaning that at 60 they're going to draw down their tris and not pay any tax on the withdrawal. Yes, appreciate that the fund will pay tax, so we're not entitled to that exempt current pension income deduction. But we're weighing up, okay, well, if the money's sitting in accumulation, not paying tax anyhow, if the fund is in accumulation paying tax anyhow, why don't we potentially look at the ability to draw down some of that money, even if we don't need the drawdown, to look at rebalancing our tax-free and taxable, or look at balancing our spouse balances as well, particularly in light of the other measure, the measure that we're all sort of waiting on to see how that's going to transpire, and that is the $3 million earnings cap. But I'm not going to jump too far ahead because I'll come back to that $3 million cap in a moment. But there are certainly opportunities with regards to the use of tris to be able to look at particularly rebalancing spouse accounts. So if we look at the use of the recontribution side of things from a tris point of view, and again, this is all going to be balanced or quite balance specific, because in this example here, I've got Jeff, who's got $2.1 million total super balance as at 30 June 2023. Now, Jeff's 62. With $2.1 million, we know he can't make any more contributions at this point of time. He does, however, want to look at making contributions, again, either for himself or for Jill, his wife, prior to his retirement. So he's looking to retire in sort of when he hits 65. Jill's a little bit older. She's obviously, in this example, got a lot less money. She's currently sitting at $420,000. He's going to work through until 2026. Jill's going to be 68. Again, we've got a big window, because even then she's got another 7 years after that to be able to contribute. So we're not having to do everything in a small time frame that we used to have from a non-working contribution point of view, and that sort of period used to be 65 to 67. We've got much longer to be able to draw out these strategies, and so we can at least look to start with Jeff and Jill at when the optimal time is to do it. So if we look at it, again, looking at their current situation, Jeff's total super balance is making it pretty restrictive for him to make non-concessional contributions, and he's currently working full time, so he can't set up an account-based pension. And again, the whole idea of even trying to be able to declare retirement in some of those circumstances, I think with the use of tris, and the capacity, particularly for larger balance members, the capacity to draw down the 10% ultimately suggests that you don't need to go too hard to try and to to try and prove something that isn't there, such as retirement. Jill, she's got a lower total super balance, so she's able to make non-concessional, and she can contribute through to 75. And the fact that Jeff's at preservation age, it means that we can start a transition to retirement income stream that's going to be tax-free to Jeff. So if we look at it, and again, the key to obviously starting the TRIS is that the TRIS is not measured against Jeff's transfer balance cap. So this is perfect in the sense that we're not over the transfer balance cap for Jeff. We're not triggering the transfer balance cap. So the fact that he's 62 means he gets to wait another 3 years until he retires. And at that point in time, let's assume that in 3 years from now that the general transfer balance cap will be at a minimum $2 million, given that we're sitting at 1.9 now. But in 3 years' time, it could be more. Who knows where inflation is going? We know that it's unlikely to be indexed next year. But again, we say that, and that's a very sort of speculative comment to make. But I think it's unlikely based on the numbers that I've been looking at there. So starts the TRIS for $2.1 million. Maximum pension at 10% is $210,000 non-assessable income. Jill, with her total super balance of 420, can make that non-concession, or Jeff can make a spouse non-concession of 210, which triggers the bring forward amount. The following year, his balance, has dropped down to 1.95. Then he's got a maximum pension of 195,000. Jill can only make 120,000 non-concessional because she's partway through that bring forward, and the bring forward is not going to reset until 1 July 2026. But again, the following year, in 25-26, Jill is ineligible to make any contributions. Her balance is sitting up around $770,000. Jeff, his total super balance is now below 1.9 million, so it's now sitting somewhere around that $1.8 million, and he can draw his benefit out. It means in the following year, the 1 July 26 year, Jill can make a non-concessional of 255, which is the excess TRIS that Jeff's drawn, and she can re-trigger the bring forward amount again. And again, by doing that, she's taken her balance from 770 up to over $1 million. Jeff obviously has been drawing down. He's now in that environment where he's under the $1.9 million. So by doing this spouse recontribution strategy, what we've actually achieved is we've reduced Jeff's accumulation phase amount to below $1.9 million, which means that's great to be able to start a transfer balance cap pension under that amount. It ensures that the entirety of the fund is going to be in exempt current pension income. So it means that Jill can have a pension, Jeff can have a pension, and they can both be account-based pensions and get that entirety to ECPI. And again, it also means that Jeff's now at a stage where he can draw down from his balance and look to make recontributions to himself to change the tax-free and taxable portion of his fund. So it really means that by using TRIS as our trigger point, we're providing a lot more opportunities, not just for the member, but for the member, the spouse, and the fund overall. So it's one of those scenarios that I think certainly works well for the entirety of the superannuation fund. And one of the concepts that I would say with regards to this, once Jeff starts to do his recontributions, is obviously if he's starting to do it into a secondary account-based pension, then, or into a new account-based pension, that each time he makes a non-concessional contribution, he would start a new pension to maintain the tax-free status of that. And again, that has estate planning ramifications, because what we're trying to achieve is, in the sort of greater sense of transactions here, is we're trying to achieve the reality that inevitably when Jeff passes away, if we assume Jeff passes away first, even if his money transfers across from him to Jill, then once Jill dies, that money's got to go out to the estate and potentially to adult non-tax dependent children. And so we're trying to alleviate the tax liability associated with that secondary death benefit. Now, one way to do that is to pay Jeff's benefit out of the fund rather than retain it there, and then do the recontribution cycle with regards to Jill, and I'll touch on that concept in a moment. So again, we see lots of opportunities that do arise from this whole idea of contemplating the rebalancing. And at the moment, we can start that from 59, which gives us effectively a 16-year timeline from a contribution point of view based on a member's total superannuation balance. So if we look at it from a pure spouse-free contribution point of view, whether we're talking tris or not, then what I would highlight there is that it really does give us the ability, and $1.2 million is probably an understatement with regards to it, but we're talking about somebody over a potential 10-year period from age 65, particularly if we're saying, one, they've got significantly more money than their spouse, then we can look at the drawing down of up to that $1.2 million. But secondly, if they've got most of that money sitting there as a taxable component, then it gives us a greater ability to move that money from taxable to tax-free over that 10-year period. And given that the bring forward rules, when they were changed, give us the ability to make full use of the bring forward in the year that we turn 75. So there's just a lot of opportunities that present themselves to the clients of both accumulating members through the use of contribution splitting, but then transitioning to retirement clients and then retired clients. And so the whole use of the spouse contribution particularly gives us a lot of opportunities in that area. What I would also sort of highlight is, and I mentioned it on that previous slide there and a little bit earlier in the presentation, the other thing amongst all of these contribution rules and requirements is this concept of the $3 million earnings tax. Now, we don't know where that's going to land. Obviously, there's been a little bit of consultation in this space, so we're not really sure what the final outcome is going to be with regards to the earnings tax. But what we do know is that it's currently set at that $3 million. So again, if we look at Jeff's situation, and we touch on his 3.1 million, and we've increased his balance from 2.1 to 3.1 for this example, and he's looking to minimise the impact or the potential impact of that proposed earnings tax, but he's also trying to maximise the benefit for Jill, but also from an estate point of view. Then again, if we work through the set of circumstances, then what we can find is that in that first year, we can take a huge amount out. Now, yes, we're going to trigger most of the bring forward for Jill at that point in time, but by pulling down that $310,000, even if he leaves some of it out of super from a spending point of view, he's then going to bring himself under that $3 million cap, so that when that comes in 26, that we're looking at, assuming it comes in around that time, then we're looking at Jeff having much less than that $3 million amount. And then you go through the same sort of process as to what he draws down, and he potentially banks money. But what we also know is that what we're inevitably doing is getting Jeff to a lower balance over a longer period of time, that he might even be able to get that $3.1 million. That if we talk through what I highlighted previously, we can turn 3.1 over 10 years into 1.9, or more realistically in this situation is by the time that Jeff's getting towards 75, knowing that Jill will be over 75, we also know that the general transfer balance cap will be much higher than $2 million, sort of in 8 to 10 years' time. And so Jeff again would be able to have taken that $3.1 million and turn it into ECPI or an ECPI environment for the fund. So even those clients that have significant balances and significantly higher than the general transfer balance cap now, if they've got low balance spouses in the fund with them, then there's great capacity to generate more even balances and avoid a lot of these potential changes that are coming. But again, they want to make sure that they get it right, because if they get it wrong, then they're going to be subject to the excess contribution rules, and we need to understand those contribution rules to make sure that we're doing the right thing by our clients when it comes to a lot of the various strategic planning that we undertake. So we know from a concessional cap point of view that our concessional cap is $27,500 unless we're eligible for the carry forward or the unused concessional contribution. Then it's going to be based on our total superannuation balance. So there's always a desire to be monitoring what an individual's concessional cap is to make sure that we contribute the right amount, because there is no limit on what we can claim a personal deduction for. So we could theoretically put in $500,000 and claim a personal deduction for $500,000. We're just creating a 460 odd, or whatever the maths is off the top of my head, $470,000 excess concessional contribution, which is probably not a wise step to take. But there's no restriction on what you can claim a tax deduction on. Probably $500,000 was a bit of an overstated example there, but you get my drift. Whereas with non-concessional contributions, like the cap is a hard cap in the sense that if you go over it, then you will be effectively impacted by the excess non-concessional contribution rules. And of course, it's linked to our total superannuation balance. And the total super balance is then linked to the general transfer balance cap. And we can put 1 year's worth of non-concessional in, which is 4 times the concessional, the base concessional, that is. If we've got between the 1.79 and 1.9 million, and then it goes down to 220 over 2 years, 330 over 3 years, subject to where you're going. But if you're non-concessional, if the total super balance is above 1.9, then the cap is 0. But the acceptance rules that are in Regulation 704 don't actually restrict us to the caps. We used to have this concept of fund capped contributions, and you couldn't put a contribution that in itself was in excess of the non-concessional cap. So that fund cap contribution rule was in a sense a very good rule to try and minimize the impact. But as the excess contribution rules have changed over time, the fund cap contribution rules have disappeared, meaning that you can make contributions now. There are no fund cap contributions, and so therefore you are going to be measured against the non-concessional cap, even for $1. So how's that going to come about? Well, it might come about because you put in too much concessional contribution, and you exceed the cap there, and you claim your tax deduction, and then that excess amount is counted towards the non-concessional cap. It might come about because you're not aware of the general transfer balance rules versus the total super balance rules, and you make a non-concessional contribution and exceed your cap. It might come about because you pay a fund expense personally and then say, just treat that as a contribution. I mean, I think most of us in the industry can put our hand up at some point in time and say, we've either done that or seen that occur with funds that we administer, where the simple answer is just to treat something as a contribution. Now, by doing that, we're going to potentially create excess non-concessional contribution. And where that's the most obvious now is with the introduction of the gnarly changes. So the non-arm's length expenditure, where we, again, doing in-specie transfers or whatever it might be, and go, I'll just treat the difference as a non-concessional contribution. That's going to be problematic. So again, the way that the excess contribution rules work, from a concessional contribution point of view, the concessional contributions are assessed by the ATO and taxed at your individual marginal tax rate. We don't have an excess concessional contribution charge anymore, but we just taxed at our marginal tax rate. Effectively, you get that determination, the notice of assessment. You get a 15% tax offset for the tax that's been paid by the superannuation fund, and then you've got time frame there, 60 days, to make an election to refund the 85% of the excess, or if you leave it in the fund, then it's going to become a non-concessional contribution. So it's one of those situations where, obviously, for most people who don't have non-concessional issues, and we know that most people don't utilize their full non-concessional cap, so they might leave that excess amount in the fund and just pay the tax in a different way. But it does give us that capacity to withdraw the money out if we so desire. Beyond that, if we exceed the non-concessional contribution cap, then again, we're going to get a determination from the ATO. And what the tax office are going to do is they are going to calculate associated earnings that apply for the financial year that the contribution is made, right up until the point in time the determination is issued. And I think that associated earnings rate is up at around that 10%. So it's not based on actual earnings. So again, lots of different ways that the ATO can calculate earnings, something they should take into consideration with their $3 million cap. But what we know is a 15% tax offset is provided on that associated earnings amount. We then get our excess non-concessional contribution determination. And this is where we've got, again, a choice. And it's a choice of two, but really is a choice of one. Okay, and that is that you've got to either choose to refund or to release the excess non-concessional amount plus the associated earnings, or you can elect to leave the amount in the fund. Now, the default from the ATO is if they don't receive a request, then they will assume that you have elected to proceed with the release authority, because the ramifications of leaving the money in mean that you're going to be subject to 47% tax on that excess non-concessional contribution. So the reality is that you'll get the election opportunity or the determination, and then individuals will elect to refund that associated earnings and the excess non-concessional contribution. And by doing so, that means that they're not going to create a further tax situation for the fund. Now, the key thing here is that those determinations require that the money be actually paid out via the tax office. Okay, so this is one of the key issues with regards to excess non-concessionals versus refunding contribution amounts. With the removal of the fund cap contribution rules, as has occurred over the last few years, there is no direct ability, or very limited direct ability, to refund money directly from the fund to the individual. So you have to go through the process, if there is an excess non-concessional contribution, of transferring that money back via the ATO system. And this is why I say the rule change that came in previously is going to create more issues, because prior to 1 July 2022, when the fund couldn't accept non-concessional contributions if you didn't meet the work test, so prior to that point in time, you would have to refund the amount if there was a contribution made after age 67 without a work test. Now, because the work test has moved, it just means that those contributions can be accepted right up until age 75. So it's certainly, therefore, problematic. What it also means is that the only times that we can directly refund the amount from the super fund to the individual is if they're ineligible to contribute. So in most circumstances, that is once they have turned 75, or if they've made a downsizer contribution after the age of 75, and they then subsequently fail the downsizer contribution rules. Now, that's a key point there, because one of the key issues is that downsizer is now available from age 55. And so somebody might think that they can make a downsizer contribution, and if they make it between 55 and 75 and fail the downsizer conditions, then that amount will just be treated as a non-concessional contribution. So the issue with downsizer now is that it could actually trigger an excess non-concessional if you don't satisfy the eligibility requirements prior to age 75. After 75, those amounts can be refunded. And of course, the rules about contributions being returned is they must be returned within 30 days of being aware that of the ineligibility to contribute, which in theory is day one. So you should be aware on day one whether or not contributions can be made. So the takeaways from today's session is that there are significant contribution strategies now up to and beyond age 75 if we incorporate downsizer. We've got the capacity to do rebalancing between spouses, the use of contribution splitting. The whole idea, as I just highlighted on that last one of downsizer versus non-concessional, is something to be mindful of. But we've got a shift in our obligation from trustees to members. So the trustees really are just accepting things based on age. Members really need to be mindful of what elections they have to make from a contribution point of view to ensure that contributions are treated the right way. And of course, who knows what's ahead with regards to future policy and the like, with the objective of superannuation. So look, that brings us to the end. Just a couple of key dates there of upcoming webinars. So on the 12th of October, we're going to be looking at SMSF expenses and deductibility of those expenses, particularly in light of the fact that the NALI legislation was released last week. Then in November, we'll be talking about SMSF benefit payments and the consequences of the multitude of options around paying money out of super. And then we'll wind up the year with talking about SMSF wind-ups. So thank you all for attending. If anyone's got any questions, then please chuck them in the Q&A box now. Otherwise, I will see you all at our next webinar in October.